welcome to BloombergQuint. We're in conversation today with veteran banker Mr. KV Kamath. He needs no introduction beyond that. He's back in India and the ecosystem refuses to let him retire. So we are very happy to have him here joining us to talk about banking and the economy. Mr. Kamath, a pleasure having you here on BloombergQuint, sir.
Thank you, Vera. Happy to be back.
Sir, I'll start right off with some of the immediate issues and then broaden the conversation. One of the things that you've been directly involved in after you come back is the process of post-COVID resolution. You set the benchmarks for the one-time restructuring which the central bank had permitted. Sir, I'm not asking you for numbers or anything, but the impression one gets from speaking to bankers is that the extent of restructuring this time has been much lower than what people would have expected. Even Crystal said that 99% of their rated companies do not intend to go in for it. Can you give us a sense, sir, on what you think is happening on the ground? Is it better than expected economic rebound? Is it demand, supply, maturity, that restructuring doesn't actually cure anything, it just delays things?
Yeah, three things as we can see. One, going into the crisis, when I looked at the numbers, when I took on this task, the corporates seem to be in much better shape than they were ever earlier. I repeat that, ever earlier. So for ever earlier, I go back to 2000. And that's a long enough spread. When the leverage used to be 4.5:1, total debt to equity. Then you look at 2010, leverage used to be possibly 2.4:1. And today, if you look at as a representative sample, the Sensex companies, most of them are deleveraged. And when I say deleveraged, their leverage are less than 0.5:1. So you're talking of a sample size which is significantly deleveraged as compared to the past. I would think that there would have been pressure on the small and medium industry side. There, I think the initial handholding done by the government went a long way in alleviating the pain. The third is the retail side of it. And I would think that the early handholding done by the banks themselves, consequent to what the regulator allowed them to do, I think has gone a long way in putting that part of the borrower, or the segment of the borrowers on its feet. So I think there is a holistic force at work here, which has kept companies in better shape than they might have otherwise been. One. Other important part is the economy has recovered much faster than what anybody gave credit for or thought could happen. So that also has worked in this context. So I hear what the bankers are saying, that the situation is much better than what they had anticipated. I think it is also better than what I had anticipated.
Is it wishful thinking, Mr. Kamath, that some lessons were also learned from the last cycle where restructuring simply delayed the pain? So maybe the bankers were a little bit more cautious this time. And same for the borrowers. They may have realized that there would be long-term implications on their borrowing costs, on their ratings. And hence, there was a very judicious approach, perhaps, to restructuring this time compared to last time.
If you see, something interesting has also happened. I think a lot of corporates have moved to try to see how they could reduce costs, borrowing costs in particular. And that is visible in the Q2 numbers. So a whole lot of things have happened. They started with a cleaner balance sheet, significantly more deleveraged than the past. They worked on getting their interest costs down. The bankers understood the game, and most importantly, the government acted to provide a helping hand very early on as required. The combination of these has meant that things have worked out for the good.
So there are still some suggestions, from the IBA suggesting that the time period should be extended till March. Some sectors like real estate have questioned whether the guidelines were too tough. Do you foresee the need to either extend the period or change the benchmarks, sir?
I would leave this to the regulator really, because we have done what we were asked to do, and now it is something that the regulator and the banks could work on.
So what's your sense beyond the sort of immediate crisis period? I don't need to tell you that the Indian banking sector has, of course, had a multi-year now crisis. It's been one thing after another. Different segments have faced their own kind of pain. As we emerge from this health crisis, which converted into an economic crisis, do you see whole or at least part of the banking system ready to sort of lend into the recovery and push that lever?
It's an interesting question. As of now, I don't see that happening. To be very honest, when I was still at the NDB, we had heads of global development banks meeting. This must have been sometime in April or so. The general view was that there would be destruction of balance sheets in a big way, including those of banks, and there would be a need for significant capital infusion. But we're not seeing that happen in India. I think here again, the credit can be taken by the regulator because the cleanup of both the borrower and the banking sector was done, I think, just in time. I think that cleanup was over sometime last year. Capital as required was brought in. Private sector banks raised capital from the market. The government lent its helping hand were required to public sector institutions, and the institutions were in the banking institutions, the financial sector was in a, I would say, in a healthy state going into the crisis. I think this contributed in our case to a system which is not at this point in time impaired as much as one could have thought it could have been. In fact, I think it is in excellent, I would say excellent shape if I look at the Q2 numbers in particular that the banks have just recently published.
Okay. Sir, a counterpoint to that, I think pretty much every bank has now withdrawn from, the sort of the infra segment, if I can call it that. Everyone's going for the AAA corporates. The PSU banks, while they have been recapitalized, one could argue that, there is still some hesitation in going big on lending, except, where the government is pushing them towards lending. Do you really see the skew that has emerged in the last few years towards retail lending and towards very high rated corporate lending broaden out in this post-crisis period, or it could potentially get even worse?
Very good question. There are actually 2 or 3 points that I want to make here. In the past, corporates relied on bank credit for project finance. After the development banks of the previous century got out of business, including ICICI, which became a bank. So the corporates continue to rely on banks, or I think the interregnum. I think banks now realize that they carry a serious mismatch of funding if they were to continue to lend to the corporates on a long-term basis, where their own access to funds is short-term. I'm sure the regulator also is clearly aware of this and wants the system to be on a healthy footing. So I would think that this was a natural process whereby the banks will move to lend in a maturity range which they are comfortable with. Equally, I think what is happening is corporates are now, at least the larger ones, now in a position to borrow from the capital market. So I would think the crisis that we faced recently and going into the last 2 years puts things in context that long-term purveyors of funds would be the capital market, and that is where access would need to be found. Whereas the banks will do everything else in the short end, starting with the retail consumer credit and then all other types of banking products that every bank does.
So the suggestions, sir, on how to make the banking sector future ready have included the thought that we need to bring back development finance institutions in some form. It's a cycle, sir. We've gone through this debate so many times over. Has anything changed to make DFIs more viable or wholesale banks more viable?
See, it's a very interesting question. If I look at my BRICS Bank experience, and the BRICS countries, each of the BRICS countries has a development bank of one form or the other. In particular, if I look at China, they have a very large development bank which has been handholding a whole lot of activity initially and continuing on the domestic front, but increasingly in a global context also. So they have found, and indeed Brazil has also found, that development banks are something that is required to handle development through the process. Now, what happened in India 20 years back or 25 years back now was access to long-term funding was withdrawn to development banks. And that is why we had to migrate to becoming a bank. Now, you then know the conditions really. If there is a development bank, the question that you'll have to really think of is, what is the access to funds? Today, we have a robust capital market, so there is an access to fund route there. B, we have global access. Again, India is, I would say, strongly a strong investment grade proposition, so we have access there. And C, this development bank could also borrow from multilateral development banks and online. And as necessary, the government could give a cover. So these are all broad thoughts that come into my mind based on what one saw happen in other domains. And I would think that is on the side of the institution. The side of the borrower, again, we see, I would say, again, 2 or 3 types of borrowers. One is private borrowers into the infrastructure project space or into very long period projects, that is projects which will take or will need long-term funding. B, there could be also another space which is government projects which are structured as corporate entities which could, or special purpose vehicles which could borrow. Again, if I look at globally, that's an example that is taken in the developing countries which are really pushed forward on this path. So you create a vehicle which is a borrowing vehicle and not the government directly, and your lending happens through the capital market process or the lending institution process, which is a dedicated lending institution, and of course the working capital and other needs from the banks. So this makes for a very elegant borrowing structure. So this is something that could be explored, because when the NDB was set up, the same question was there. Is there space, or is it the right time for another development bank? What was established there is countries of the South can come together, set up a credit a development bank which has a better rating, a significantly better rating than its parents. So in our case, in the case of NDB, the credit rating of the BRICS countries was probably just about investment grade. But we had a rating of AA plus, and the highest rated bank country in our members was China with an A minus. So we had a AA plus. So actually, in a way, there was a transformation in the rating when this institution started borrowing. So there are a lot of learnings that are coming out now, and the policymakers will have to think about this and then look at whether it is appropriate to set up a bank given our needs. But the needs are going to be large, that is for sure, because high aspirations have been set by the government, rightly so. To meet these, I think you need institutions which could provide the support for this process.
That's very interesting. The broader question, Mr. Kamath, and you already weighed in on this, is a feeling that we need more banks. And I know this feeling has persisted for a while. We've experimented with the small finance banks, the payment banks, and now there is two levels of talk. One, as you already weighed in on, corporates into banking, or large NBFCs converting into banks and having access to a wider deposit base. Do any of those two ideas sort of resonate with you again at this juncture, given where we've come from in our banking system and where we need to go?
See, again, I heard the governor say that this is not the Reserve Bank's view. This is a discussion paper which has been prepared by an internal working group. But this is an internal working group paper, and it has been now put out for discussions. Let me put it that way. I think we have to respect what the governor says and live within that construct. But thoughts, this gives a scope to thoughts, and various people have given their views. At one end is the view that this raises governance issues, and at the other end there have been views that time is right. I would pitch it as follows. Clearly, we need more lending institutions which are able to support the aspirations of a 5 trillion economy and beyond. That's point number one. And extant institutions will have to grow at a pace which maybe the regulator could end up being a little uncomfortable, because you need to grow significantly fast to do this. B, you have a sector, the non-bank finance companies in India which are lightly regulated or regulated lighter than the banks, which the regulator wants to make sure continue to provide the support and not become systemic risk, or which, as they become systemically important, that risk increases. So they want to address this. I think these are things that any regulator is absolutely correct to think about. Now comes the issue of who then will be these new players who will push things forward. I think clearly the NBFCs become a set of candidates, and the larger ones are out of these for sure. Others, the paper puts out that these could be private enterprises which could become the promoters of these banks. Another interesting point that has been made in the Reserve Bank working group paper, if you look at the banking sector as a percentage of GDP, it is 70% in India, whereas it is 170% in China. Now, what the point that is being made there is that to grow at our aspirational growth level, you need the banking sector to play a more significant role in the overall context. Point number one. Point number two, I think that has been made very clearly there is that if you look at the existing structure, capital, access to capital has been far better in the case of private banks because they could go and raise money in the market, whereas as far as the government banks are concerned, they had to access funding from the government. The point has been made in the working group. The third, they talked about utilization of capital, which again they say is better in the private sector. And fourth, the operating ratio, the operating, which again they feel they have put out is better in the private sector banking space. So all this has been given as a preparatory or the environment to banking in the paper, and based on that, they have raised this thought that would this be the right time to allow entry of new private players into the space? Then comes the important issue that a lot of people have raised. Will this raise a governance issue? My simple submission here is, a few years back, certainly there could have been questions, will it raise a governance issue? And there are several key things that have started to happen, which I think today probably addresses that fear of risk, that fear of that risk. So let us look at one of these things. Do you have the ability to take a consolidated view of the system and its borrowers? 3 years back, I would have said no. Today, you have a consolidated view of the borrowing by a corporate across all banks. Now, aggregating this, if it is a borrower, you can now aggregate all the borrowers, and within that, I think it's a small step then to code them to see which set of borrowers are from which group or entity, and then again look at the movement between banks to fund these entities. And I think it becomes much easier today in a technology context, given where we have moved on to address this concern. I'll give a small example. Isn't CIBIL tracking on real-time basis every single payment that you and I do? And isn't the system better for it? Today, a retail borrower think twice before he is going to borrow beyond his means and get a negative score. I would think that good behavior will also come about once it is known that on real-time basis, your transactions are being tracked. This is one. Second is, I think the Reserve Bank has very clearly in the working group paper said that there would need to be internal strengthening of internal processes and supervisory. Indeed, they would do that. At the end of the day, what will happen, as I see, is you will have a system which will be supervised and monitored in a much tighter manner than it is today. At that point of time, the Reserve Bank has options to allow the type of players they want, and they believe they can properly supervise to deepen and widen the system.
So, sir, absolutely. Access to data, and if that public credit registry comes into place, then that gets taken a step further. On the governance side, so they've made some changes. For instance, in compensation at the bank CEO level, they've done some changes at the board level. But if one had to again, sort of reinforce the governance structure beyond just the access to data, do you think the board level reforms can still be taken further?
Again, I saw a paper which was, I think, put out early this year or last year, and I didn't study it in detail. That was on risk management and other aspects of how a bank should function. I think the steps brought out there are, I think, very appropriate. They may need fine tuning. That's up to the Reserve Bank to think through after it, probably discusses and understands. But to me, the steps are very timely because, from an external point of view, the 5 years that I spent abroad, where I find the whole thought process is now moved in the context of banks, is greater responsibility for audit committees, greater responsibility to the internal auditor, and greater responsibilities to the compliance function. Now, if these can be tightened, significantly, as the Reserve Bank wants, the bank to do, including the reporting structures for functionaries under these, in these functions, and B, I would say, overlay technology into these functions, I think we are into a much better system where we should then not fear that is there a governance issue that is lurking somewhere behind us.
So, in many ways, whatever we've spoken of so far is legacy issues in the banking system. The world is changing. Technology is changing banking in ways that we would have never anticipated. Obviously, in India, a lot of that has happened on the payment side first. Again, from your vantage point, as you looked around the Asian ecosystem, whether it's Singapore with digital banks or, Ant Financials of China getting into lending, becoming among the biggest consumer lenders, where do you think the innovation in banking in India now needs to focus on, sir?
Yeah, I think it connects back to the economy. So I'm going to connect it for a moment and then, actually dive into your question. The economy of the future, as I see, is going to be driven partly by what we know. The legacies, growth drivers that we know. This include all the things I won't go into. And there will be another driver, which I think is going to be probably the most significant driver, which will add the most value added, as it were, to the economic product. And that would be what I would paraphrase as the projects and the activities which will come under the digital super cycle. If the digital super cycle is on us, and I believe it is on us, then I think clearly the banks have to be a player in this super cycle. And each bank, therefore, needs to take a hard look as to how competent are they to be a relevant player. Because what we have seen, again, from an external context is, at the margin, in several significant areas, which historically were done by banks, you now have newer players, who are actually riding, I wouldn't call it fintech anymore, I would call it the digital super cycle, who are becoming the key drivers. And the financial sector, not just the banks, will need to ask itself a question: are any of these new players going to make us redundant or marginalize us? Or are we going to be only protected to the extent that the regulator protects us? So this question, to my mind, is relevant to banks. It is relevant to insurance companies. It is relevant to broking companies, and indeed, it is relevant to every single entity which is in the financial space. So what you have just now asked me is a much bigger problem than a narrow issue of induction of technology by banks, the induction of appropriate technology, fintech technology by banks. To me, that question is passé now. You are now looking at a much bigger question which you have to answer. How, as a bank, am I going to be a part of the digital super cycle? And how do I make sure that I am relevant? This, so that I want to make sure that how do you distinguish? I think this means that you need to rethink your entire technology infrastructure, your entire technology architecture. We are not talking of at the margin doing something on using fintech. We are talking of something entirely different, which these new players are leveraging. So will you as a bank be comfortable doing it? How will you go about doing it? Over what time? How will you convince the regulator? So in short, I'm saying that for the extent financial services system, it's a very exciting time. It's very exciting, and it's very exciting because they have a lot to do to ensure that they stay fit and strong for the long run.
And you do see a much larger role for non-banks, even in traditional banking sort of strongholds like deposits and lending. I mean, lending, we've already seen the digital lenders take off. There's talk of disintermediation even on the deposit side, although we don't have account number portability, etc. But I think as the ecosystem progresses, sir, banks will probably have to realize that there's nothing that's sacrosanct to them beyond perhaps just retail deposits.
No, in fact, I will expand what you said to include all financial sector players. Will have to recognize that there is nothing sacrosanct about what they do, and they will basically have an advantage as long as their respective regulators, deem it appropriate to provide that advantage. But clearly, regulators are also going to think on several frames. I'm sure the interest of the banks in the context of their health, because that is critical to say the depositors and so on. But they also think in terms of where are we heading, where is the country heading, and what is that we need to do. So I'm sure that it is going to be an interesting 3 years going ahead from now to see the evolution in this space.
So before I run out of time, a last question or two on the economy. What do you see the needs of the economy into next year? Now, just by virtue of pent-up demand and statistics, we will start to see growth rates go up. But levels of economy will take a while to go to pre-COVID levels. To aspire for 8% sustainable growth is another step further. To your mind, what's the judicious policy mix? Keeping in mind the experience you and we all lived through, which is the post-global financial crisis period.
Again, I was actually delighted to hear the governor talk about what policy environment he would like to see for the next through the next year. That's the phrase I think that he used, and it was a very conducive policy environment. In that, it had elements of keeping interest rates, I think, and liquidity at the levels that we have now, which would mean that keep interest rates low and liquidity, in an easy liquidity situation. I think that is what is required for growth at this point in time. And I see that you have put up the repo rate trajectory, or about to put it up. I would think that this is a time where we have almost everything below the policy rates. I think it is a wonderful situation to be in to drive the economy forward. A. B. I heard the governor talk very optimistically about where we will head into Q2 and where we will head for the year. I think my takeaway is by the Q3. By Q3, we should come to what you would call a break-even level, and then you will have an interesting situation of how much we drive in Q4, which will set, I would say, the benchmark for this year. I would say that for the coming year, aiming at an 8% growth is probably the minimum that we should aspire. 8% not on what we did in 2021, but 8% on what we did in the previous year. That is 1920 is what we should look at for the year 21-22. And I think that should give us then the momentum that is required. My view is also based on what I've seen in the last few months, that is at least the last 2 quarters. Corporate India has reset its mind. Consumer India is also reset its mind. You and I were the early resetters of our mind, and our homes, the homemaker was the earliest to reset minds. So you never had this sort of an equation before, where in the entire economy, almost everybody has reset the mind. So to drive growth should be a much easier proposition than what we have done in the past. Of course, time will tell us where we will be.
But we'll have to ward off, sir, some of the mistakes that happened in the post-global financial crisis period. Easy liquidity leading to, zombie lending or lending to unviable projects, or inflation sparking up because of high easy liquidity and positive fiscal policy or a conducive fiscal policy. We'll have to ward off some of that, sir.
I think some, of course, we'll have to keep our antennae open, but some of these fears I don't think will come true, because I would think today's borrower is a much better informed borrower. He's much better informed of the consequences of borrowing where he cannot actually meet his obligations. So I think the lessons learned are going to be in a good stead. And we have not seen profligate borrowing in the last 6 months, and I don't expect that will be the norm going forward. We will have borrowers, hopefully, who are responsible, bankers who also lend in this environment. So I would think that I would rather go into this with a very positive frame of mind, low interest rate, ample liquidity, responsible borrowers, all working together with one intent, that is drive the country's growth to levels which will make our aspirations fulfilled. And in all this, I think we are well on the way.
All right. I'll leave it at that, Mr. Kamath. Very kind of you, and thank you so much for your time here on BloombergQuint, sir.
Thank you, Veera. Thank you very much.
Bye-bye. Thanks for watching Bloomberg.